We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Richard Duncan. He's an author of 4 books now, including his newest entitled The Money Revolution. He's also a macroeconomist and the founder of the video newsletter Macrowatch. How are you today, Richard?
Hi, Tom. All's well here. Thanks. Thanks for having me back on.
It's excellent to have you, and I'm really looking forward to this conversation. I've gone through the book quite a bit, and you really bring some real interesting ideas to light. I hope our listeners get a good kind of overview on some of your ideas, and if it interests them, obviously they can check the book out. And it's a pretty big book. It's 500 pages and 250 charts. So how long did it take you to write that whole book?
Tom, I started writing this at the beginning of 2018, and it was, I would say, 95% finished by the time COVID started. But then when COVID hit, it required rewriting a couple of chapters, adding a new chapter, and just waiting for a year passed with the book on pause, just waiting to see how much money the government would end up spending and how much money the Fed would end up creating to get through this pandemic without our economy collapsing. So altogether, it took 4 years from start to finish.
Yeah, and of course, those are some really important points in the book. And in some ways, a proof positive of some of the ideas you're talking about, right?
Yes, it's interesting. As you mentioned, this is my 4th book. My first book was called The Dollar Crisis, and it had perfect timing. It came out 19 years ago. And when it came out, the dollar started dropping and dropping and dropping, and it dropped for a couple of years. So it was a perfect background for a book called The Dollar Crisis. Unfortunately, with my new book, The Money Revolution, and the subtitle is How to Finance the Next American Century, the timing has been pretty horrible, to be honest with you. It will become more obvious why. But first of all, we have, as I mentioned, COVID delayed the book for more than a year. And then once the book came out, the war between Russia and Ukraine started, not only sucking up all the headlines, but also pushing up the inflation rate to very high levels, which was something that my book did not anticipate.
And of course, one of the other, let's say, important themes, I guess, that the war has really underlined is the role of globalization and maybe the move towards deglobalization a little bit, but we'll get into that a little bit later in the conversation here. So the book is mainly divided into 3 parts. So can you give us a quick overview of each part?
Okay, right. So there are 3 parts. The first 2 parts are history, the history of money and the history of credit over the last century in the United States. And the 3rd part draws on lessons that we can learn from that history to make better policies for the future. So very briefly, part 1 is a history of the Federal Reserve from the time it was created up until now. But it tells a history in a very unique and precise way. And it's important for everyone to understand the Fed because the Fed is the world's most powerful economic institution. It is the US government's most effective policy tool. And if it were a corporation, last year, it would have been the most profitable corporation in the world. It made more profits than Apple. So what it does determines whether asset prices go up or asset prices go down. It has the power to create credit or to destroy credit. And that power has an enormous influence on what happens in the economy. So it's very important for everyone who's interested in economics or in investing to understand the Fed, because what the Fed does really drives both the economy and the financial markets. And so the first part of this book tells the history of the Fed in a very precise way by discussing the changes in the Fed's assets and liabilities over 10 consecutive periods from 1913 up until last year. And changes in the Fed's liabilities show exactly how the Fed creates money. And changes in its assets show exactly what the Fed does with the money that it creates. And so by telling the story in this way, you can see how the Fed developed new methods for controlling monetary policy during the last 110 years, and often why it developed these new methods, frequently in response to crises like World War II, for instance, or the crisis of 2008, or more recently, the COVID pandemic. So that's the part one, the history of the Fed. Part two is the history of money, of credit. Mm-hmm. So the big change, the most significant change in the history of the Fed and the history of money occurred in 1968, when the United States stopped backing dollars with gold. Up until then, it was a law that the Fed actually had to hold gold for all the dollars it created. But in 1968, the Fed didn't have enough gold to issue one more dollar. So Congress changed the law and ended the requirement that the Fed hold any gold to back the dollars it created. And afterwards, there was no longer any link or any connection whatsoever between dollars and gold. And that soon spread around the world. So there ceased to be any connection between money and gold after 1968. And this unleashed an explosion. This allowed an explosion of credit creation to occur. And that is the topic of part two. Total credit in the United States. That is the total credit is the flip side of total debt. So this is, you can think of this as the debt of all the sectors of the country: the government debt, the household sector debt, the corporate debt, the financial sector debt, all the debt. In 1964, the total amount of debt or credit was $1 trillion. By 2008, it had expanded 50 times to above $50 trillion. And so a 50-fold increase in credit in just 43 years. And now it's 90 trillion. So this explosion of credit fundamentally changed the nature of our economic system. In the past, the thing that drove economic growth was saving and investment. Businessmen would invest. Some of them would make a profit. They would accumulate that profit as capital. And so they called it capitalism. And repeat, it was pretty slow and difficult. Saving, investment, saving, investment. That was how they generated economic growth in the past, but that's not how things work now. Our economic system now is driven by credit creation and consumption, and more credit creation and more consumption. So I think a more appropriate name for our economic system today is Credit-ism. I believe that capitalism evolved into Credit-ism once dollars ceased to be backed by gold and credit exploded. And so in the second part of the book, I trace how this occurred and the impact that the extraordinary expansion of credit and the sources of credit changed, and how that impacted the economy, and how it caused our economy to become addicted to credit growth, pointing out that if we don't have credit growth, the economy goes into recession. And if credit contracts, we have a depression. So the US economy now is dependent on credit growth. And the book, part two, shows that anytime total credit in the US, and this is adjusted for inflation, anytime total credit grew by less than 2% from 1950 up until the crisis of 2008, the US went into recession. So we need at least 2% credit growth adjusted for inflation just to stay out of recession. That happened, there were 9 recessions between 1950 and 2009. And in every one of them, it was because credit grew by less than 2% adjusted for inflation. Mm-hmm. So that's the second part of the book, credit. And the third part of the book is called The Future. And it draws on the lessons we can derive from the history of money, the history of the Fed, and the history of the evolution of our economic system from capitalism into Credit-ism. It draws on those lessons told in the first 2 parts of the book to recommend policies for the future. And to cut to the chase, the final part of the book recommends that the US government fund a multi-trillion-dollar investment program over the next decade, targeting the industries and technologies of the future, in order to ignite a technological revolution that would turbocharge US economic growth, guarantee U.S. national security for generations to come and radically enhance human well-being, not only in the U.S., but all around the world. So you mentioned earlier about the timing of this book. One advantage that this book has had is that a multi-trillion-dollar investment program sounds like a very large number. But in response to the COVID crisis, the US government borrowed $1.4 trillion in just 1 month, April 2020. Mm-hmm. And during that second quarter of 2020, in total, they borrowed $2.8 trillion in just 1 quarter, 3 months. And the Fed financed roughly 75 or 80% of that by creating money and buying government bonds. So that demonstrates how easy it would be to carry out a multi-trillion-dollar investment program over a decade when the government can have a multi-trillion-dollar borrowing spree in just 3 months.
Mm-hmm. So, Richard, before we really dig into the future part of the book, I'd like to kind of go back and talk about some of the other topics there. So to me, one of the most interesting parts of the book, of course, it has been talked about tons here in the past, let's say the past year. To me, one of the most interesting parts is how you look at inflation. So is inflation always and everywhere a monetary phenomenon?
No, it's not. Chapter 15 of the book is titled Inflation, and it covers inflation decade by decade, starting in the 1920s. So it covers every decade and discusses the causes of inflation and deflation in each decade. And what it shows is that in recent decades, changes in the money supply have very little, if any, impact on the inflation rate. Mm-hmm. What has become the main determining factor of inflation in recent decades has been globalization. Globalization is extremely deflationary. I'll elaborate on that in just a bit, but you ask what are the other causes of inflation? Well, in addition to changes in the money supply, inflation in the past has been caused by supply shocks or demand shocks. And within supply shocks, there are inflationary supply shocks and deflationary supply shocks. So for instance, an example of an inflationary supply shock would be like the oil shocks of the 1970s, where the Arab oil embargo cut off oil supplies and that caused the inflation. That wasn't due to changes in the money supply growth. Now, COVID also induced a supply chain bottleneck. So that was an inflationary supply shock. And Russia's invasion of the Ukraine, that is, again, an inflationary supply shock. But there have also been deflationary supply shocks, like technological advance, which has driven down the price of many things, such as communications, or globalization being the most important. And then there are demand shocks, inflationary demand shocks, like World War II, for instance, and deflationary supply shocks, like the COVID lockdown months where people were locked down at home and couldn't spend. That was deflationary. So Milton Friedman said inflation is always and everywhere a monetary phenomenon, but that's not true. For example, once globalization kicked in, and I believe that it started in the early 1980s, the US started buying more and more things from countries with very low wage labor. Before 1980, the US trade was in balance, more or less in balance. But starting in the early 1980s, the US started buying much more from the rest of the world. By the middle of the 1980s, the US trade deficit was 3.5% of GDP, which was entirely unprecedented. But by 2006, it had blown out to 6% of GDP. And so what this meant was suddenly the Americans were buying hundreds of billions of dollars of goods from countries with labor that cost less than $10 a day. And so that pushed down wages in the US, but also pushed down the prices of manufactured goods in the US. And that was extremely deflationary. So since the early 1980s, we've seen the inflation rate drop from double digits to below zero from time to time, up until the COVID pandemic started. And one very good example of this was following the crisis of 2008. In response to that crisis, the government started running trillion-dollar budget deficits. And the Fed had 3 rounds of quantitative easing between the end of 2008 and 2014. The Fed created $3.5 trillion in those 7 years. and that expanded the size of their total assets by 5 times in 7 years. The biggest jump in any one year was in 2009. The Fed created so much money that the money supply grew by 110%. Then a couple of years later, in 2011, it grew by 34%. And in 2013, it grew by 39%. That compares with just something like 25% money supply growth during World War II at the peak. But this extraordinary surge in money supply growth didn't lead to high rates of inflation at that time. No, we had 110% growth in money supply in 2009. But in the years immediately after that, the inflation rate peaked at 3.8%. That was as high as inflation got. So if Milton Friedman were right and money supply growth causes inflation, then we should have seen hyperinflation after 2009. Instead, the CPI peaked at 3.8%. That was in 2011. And by early 2015, prices were negative again. There was deflation the first few months of 2015. So that shows us that globalization and the deflationary forces of globalization are much more powerful than the inflationary forces that used to result from increases in the money supply growth.
Mm-hmm. Yeah, I mean, going through that part of the book, there's so many conversations that I've had that, every time we think about money printing and QE, we automatically assume that growth in money supply results in inflation. And it's interesting to see how you go through that and really lay it all out.
Well, it's not surprising that people believe that because, of course, that's what the textbooks teach on economics, and that's just ingrained in the public mind as the main cause of inflation. And indeed, it was in the past. But this is where the history of money is so important. Because again, when we stopped backing dollars with gold in 1968, that created extraordinary changes. For example, when gold was money, if the United States had a big trade deficit with some other country, it would have to pay for its trade deficit by sending its gold to the trade surplus country. And that would have meant pretty soon the US gold supply would become less and less, meaning the money supply would contract, which would be very deflationary and extremely bad for the economy. The US would have suffered a severe recession. Their unemployment would have gone up. And pretty soon we would stop running a trade deficit because we just didn't have enough gold to continue paying for the trade deficit. But once we no longer backed dollars with gold, then it soon became clear that the US could run big trade deficits with other countries, and it didn't have to pay with gold anymore. It could just pay with paper dollars or treasury bonds denominated in paper dollars. And that changed everything. That changed everything completely. Mm-hmm. That meant that we no longer were constrained by the domestic bottlenecks in the United States. In the past, if the government had spent too much money, or if the Fed had created too much money, that would have led to overheating of the domestic US economy. Everyone would have had a job. All the industrial capacity would have been fully utilized, meaning, for instance, the steel factories would be working at full capacity. The automobile companies would be producing as many cars as they possibly could. And everyone would be so fully employed that wages would start moving up and the prices of manufactured goods would start going up. If you overheated the economy then, you got high rates of inflation. Mm-hmm. And that's what happened in the 60s and the early 70s. But after globalization kicked in, then we no longer had to rely just on the domestic economy. We had the whole world. And the global population is 23 times larger than the US population. Most of the rest of the world earns far less than American workers do. So this became extremely disinflationary, deflationary. And that meant that as soon as the 1980s started running these large trade deficits, President Reagan was elected. He had extremely large budget deficits, the largest we'd ever had. And the Fed accommodated that by creating a lot of money during the 80s as well. But instead of that causing high rates of inflation in the 80s, the inflation rate just came down and down and down regardless. And that's the way things were. Globalization kept prices under control. It was extremely disinflationary. So inflation was low. So interest rates were very low. And low interest rates created the big boom in the financial markets that we've seen, creating a lot of wealth and creating a wealth effect that helped drive economic growth in the US. And that was the environment that I was looking at the first 2 years that I wrote this book, The Money Revolution. I thought, okay, if we can get away with having trillion-dollar budget deficits and the Fed creating trillions of dollars to finance those budget deficits without having significant amounts of inflation, then we should take advantage of this and have the government invest in new industries and technologies on a very aggressive scale, as I said, to turbocharge the economy and create technological breakthroughs and medical miracles. Mm-hmm. But then we got hit by COVID, just about the time the book was about to be printed. And this changed everything, because it changed everything again in a bad way, because it was a severe blow to globalization. Suddenly, we had global supply chain bottlenecks that shut down factories not only in the US, but all around the world. And this didn't just last for a few months, but round after round. First, the first round of COVID, then the Delta round of COVID is still going on. Now, Omicron is spreading around China, and China is being locked down. Cities with millions of people are being locked down. It's uncertain how long this is going to go on. But as a result of this has been one of the main reasons why the inflation rate has moved so much higher in recent months. And just when there was hope that COVID was going to abate and these supply shocks caused by the problems to the global supply chains, just when there was hope that that would begin to abate this year, Russia invades Ukraine. And there's a second very severe blow to globalization, with oil prices now shooting up and food prices shooting up since Ukraine and Russia produce so much wheat and other crops and metals. So this has been a real blow to globalization. I would say that globalization has been probably the most important economic theme running throughout my career. I first became aware of its likely impact when I moved to Hong Kong and started working. I began my career in Hong Kong in 1986. And soon after that, I went on business trips to China to look at factories. And there were factories as far as the eye could see, full of 19-year-old women earning about $3 a day. And it immediately became obvious that this was going to profoundly impact the United States manufacturing. It was clear the U.S. could not compete with $3 a day labor, and that the U.S. would lose its manufacturing. This would put downward pressure on wages, and also inflation. It would be very disinflationary/deflationary. So that has been the main thing that I have focused on, I would say, throughout my career. The main theme is globalization. But now there's a chance that globalization is going to end or be reversed or partially reversed. It has already temporarily been reversed. It's not clear how long it's going to be in its current weakened state. On the positive side, COVID may end very soon and never come back. And the war in Ukraine may end tomorrow, and the Russian troops withdraw, the sanctions are removed. Then a year from now, we could be back where we were 3 years ago. Globalization's in full swing, and it's once again extremely disinflationary, opening up all the opportunities that we had before these blows to globalization occurred. On the other hand, the next COVID variant may be even worse, disrupting global supply chains even longer, and this may go on for years and years. And looking at a worst case scenario, the war in Europe could spread to other countries or all around the world, which of course would be a terminal blow to globalization, resulting in persistent high rates of inflation for years, meaning that the interest rates would also have to move to much higher levels, similar to what we saw in the early 1980s, which would crush the economy in the United States and around the world, and absolutely crush stock prices and all asset prices, particularly the most speculative ones.
Well, let's hope the first scenario plays out a little bit better than the second one, right?
I believe it will, but it's uncertain. It may not. It could go the other way.
So the final part of the book, which is called The Future, presents how you see a previously unimaginable opportunity to grow and prosper by investing on, an absolutely massive scale in the industries and technology of the future. So can you give us an overview of really what your vision of that is?
Right. So again, keep in mind that this was written at a time when the inflation rate was below the Fed's target. And so my thinking was, all right, if we can have trillion-dollar budget deficits and the Fed can create trillions of dollars financing these deficits without creating high rates of inflation, then we need to take advantage of this to the fullest and invest in a multi-trillion-dollar scale in the industries of the future. Things like quantum computing, artificial intelligence, genetic engineering, biotech, nanotech, neuroscience, robotics, and renewable energy. And clearly, if we were to do that on a multi-trillion-dollar scale over a 10-year period, this would create miracles and turbocharge the economy. Now, there's a lot to discuss here. First of all, I don't put a dollar amount on exactly how much we should invest over the 10-year period. Mm-hmm. I say instead that we should invest, the government should invest as much as possible, as quickly as possible. And if it causes overheating in the US that leads to inflation, then they can rein in the investment until the bottlenecks causing the inflation have been overcome, as they eventually always are, and then resume the investment. But I do use an example just for illustrating how such a large investment would impact the government's budget and the Fed's balance sheet. So I use an example of a $10 trillion investment over 10 years. Now that sounds like a lot, right? But as I mentioned before, the government borrowed $2.8 trillion in just the second quarter of 2020. So it would be very, very easy for the US government to fund an investment program on this size. And I show in the book, chapter 19, that if the government were to invest $10 trillion over the next 10 years and creating an absurdly pessimistic worst case scenario, assuming that every last penny of that is wasted and that nothing good whatsoever comes from that, then 10 years from now, the level of US government debt to GDP would be 150% of GDP versus 120%, which is what it's likely to be 10 years from now, mm-hmm. based on the projections from the Congressional Budget Office. So 150% of GDP 10 years from now in that scenario where all the money is wasted. Japan's government debt to GDP is already 250% of GDP. Their ratio of debt to GDP, government debt to GDP, went through 150% 20 years ago. So 10 years from now, we would be where Japan was 20 years ago. That shows you how easy it would be for us to finance this. Mm-hmm. Now, in terms of what I'm also proposing is that the Fed effectively just do quantitative easing to finance this entire 10 trillion investment program. And that way, it wouldn't cost the American taxpayers a thing.
Mm-hmm. Richard, before we move on, can we explore some of the differences, let's say, between the US and Japan? So Japan's yen isn't the reserve currency of the world, and they also finance most of their debt internally versus the US having foreign creditors. So is it a possibility that the dollar becomes worthless in this scenario and the rest of the world starts dumping US treasuries because of that?
No, I don't think so. The reason that the US is the international reserve currency, initially it was because we won World War II and had most of the world's gold. But things have evolved since then. The reason there are so many dollars abroad is because the United States has such a large trade deficit. Last year, for instance, the US trade deficit was $1 trillion. What that means is that threw off $1 trillion into the global economy. And so there were $1 trillion more in the global economy at the end of last year than there were at the beginning of last year. Now, let's use China as an example. China's trade surplus with the US is more than $400 billion. And that's because Chinese manufacturers sell their goods in the United States and they get paid in dollars. And they take their dollars back to China. Now, once the dollars get back to China, they have to do something with the dollars if they want to earn any interest. And so they buy treasury bonds or bonds issued by Fannie Mae and Freddie Mac, or in some cases, other corporate bonds or even stocks. But they have these dollars and they have to do something with them. You may be thinking, okay, well, they could sell the dollars and get euros, for instance. That's true. But whoever they sell those dollars to, they'll then have the dollars and they'll have to buy treasury bonds with them. So the dollars aren't going away. They're like farmland. The farmer can sell his land, but that doesn't make the land disappear. Someone else owns it. And as long as the rest of the world wants to sell things to the United States, then the US is going to have a big trade deficit and there are going to be more and more dollars in the global economy. And this will actually make it easier for the United States to finance the kind of investment program that I'm talking about.
Yeah, it's interesting how you use these examples of how, again, going back to the example of how much currency was created in response to COVID, and also using Japan's debt to GDP ratio as the other example of how this can actually happen. And if all of this currency gets wasted and it doesn't create any growth in GDP, it doesn't increase our debt to GDP ratio in a relatively dramatic sense from where we are right now, right?
Right. And of course, an investment program like this would create extraordinary economic growth. It wouldn't be surprising if the GDP of the country started growing at a double-digit rate. We would have such a surge in productivity and technological breakthroughs that it would just turbocharge the economy. Mm-hmm. So the economy 10 years from now would be much larger than it is likely to be if we don't make this sort of investment program. Mm-hmm. So rather than the level of debt to GDP being higher, 150%, in my example, it would be much lower than it's likely to be.
Versus, I think it's being forecasted, if I remember right, it's 122% without the investment program. And even if everything is wasted, it only takes us to 150%, something like that, right?
That's right. But that's assuming the economy doesn't grow at all as a result of this investment,
exactly,
which is a ridiculous assumption.
Yeah. To help kind of conceptualize, let's say, the need to actually invest in the US economy, can you help us compare how much China invests as a percentage of GDP versus the US over the last 50 years here?
Yes, but just one more word before we go in that direction. Mm-hmm. Let's talk about how this sort of investment program would be structured. Of course, the government could invest directly the way that it did with NASA during the 1960s, more or less under one big roof, with the government managing everything, providing the money, investing the money, and overseeing the project. That worked. But there would probably be a better way to do this. And this is what I propose in the book, that the government fund the investment program, but allow these investments to be actually managed by the private sector, by the leading entrepreneurs and scientists in the country. So here's what I would propose, that the government select the 10,000 most promising American entrepreneurs and scientists and set up joint venture companies with them, with the government providing the funding and in exchange keeping a 60% equity stake of these companies, and with the entrepreneurs and scientists managing the companies, and in exchange they keep a 40% equity stake and manage the company. Now, when one of these well-funded, lavishly funded companies invents a cure for cancer, for instance, then that company would become enormously profitable and so valuable. You could list something like that on NASDAQ for $5 trillion with the American government, in other words, American taxpayers, keeping 60% of that. So these sorts of investments would create so much value that would accrue to the government that this investment program would pay for itself many times over. So rather than causing the level of government debt to GDP to go higher, it would cause the level of debt to go down and the level of GDP to go up. It wouldn't be surprising. Not only this could pay for itself very quickly over the next 2 or 3 decades, and then start driving down the cost of the overall level of government debt to GDP, just because it's so immensely profitable. And along the way, we could probably cure all the diseases and radically expand life expectancy, just as 2 examples of the sorts of benefits we should look to from an investment on that scale. For instance, right now, the National Cancer Institute, its annual budget is $6 billion a year. Up until very recently, quantitative easing, the amount of money the Fed created, was $120 billion every month. So the annual budget of the National Cancer Institute was equal to 5% of 1 month of quantitative easing. Well, $6 billion is not curing cancer, and 600,000 Americans are dying of cancer every year. So how about using one full month of quantitative easing? Instead of $6 billion, let's take that up 10 or 12 times and see if that works. It probably will. And the same goes for curing Alzheimer's and heart disease and kidney disease. If you invest on this scale, we really have a real shot at curing all the diseases. And of course, the implications of that are fantastic. That means spending on Medicare and Medicaid would plunge and life expectancy would expand. So Social Security cost would drop. Again, reducing future levels of government debt. So many people are worried about US Social Security and Medicare funds going bankrupt 30 years from now. Well, let's not wait 30 years. Let's invest now and cure all the diseases, and we won't have that to worry about. This is the sort of thing that would be possible with a multi-trillion-dollar investment program.
Mm-hmm. This in some ways reminds me of an idea that Eric Weinstein talks about on his podcast, The Portal. He speaks about the US really hitting an innovation wall in the early to mid 70s. And you're almost presenting this idea as a kickstart to restart that innovation, a new Manhattan project of sorts. Is this kind of a fair assessment?
Right. Of course, during World War II, the government invested on an extraordinarily large scale and government debt went up a lot. But those investments produced an extraordinary wave of innovations that increased US productivity and led to an economic boom, not just during World War II, but all during the 50s and extending on into the 60s. But then we had the Sputnik crisis in the late 50s, and that again encouraged the US government to spend a lot more on basic research and development. So there was another big significant pickup in government funding of research and development in the 60s. But by the 1970s and ever since, government funding of basic research and development has been on the decline. And that explains why US productivity and US economic growth have been on the decline. The US is just investing far too little, dangerously little, which brings me to your earlier question about China. Mm-hmm. China is soon going to overtake the United States as the world's most powerful country because China invests a lot more than the United States does. As a percent of GDP, China invests 42% of GDP. The US invests only 21% of GDP. And in terms of investment specifically in research and development, in the year 2000, the United States invested 8 times more than China did in research and development. But in 2019, China overtook the US in R&D investment and is now investing more. And if current growth trends continue, by the end of this decade, in 2030, China will invest 40% more than the US will in research and development. And if that occurs, the United States will probably never be able to catch up with China again. The biggest threat is that China develops artificial intelligence to the point where machines are as intelligent as humans are, because after that point, artificial general intelligence, they call it, after that point, the intelligence of these machines increases exponentially. So whoever reaches that point first will have the rest of the world at its mercy. It would be even greater than thinking of a country having a nuclear weapons monopoly, as the US did for just a few years at the end of World War II. Whoever gets to AI, general intelligence first, the world belongs to them. So we have to make sure that it's the United States and not China. There's no reason that the US should allow China to overtake us technologically, economically, and therefore militarily, when we could so easily afford to invest in these new industries and technologies on a multi-trillion-dollar scale. We could out-invest China by a large measure. Mm-hmm. And that's what we need to do. China has hypersonic missiles and 5G, and the United States doesn't because China invests more. And these trends are only going to become worse unless the US immediately changes its course and begins investing much more aggressively.
So in that vein, Richard, do you think that there is any possibility that the government will invest in new industries and technologies as you're recommending?
So I've been talking about this for a number of years, and people have frequently asked me that. Do you think there's any, that's all very interesting that they would tend to say, but the government is never going to do that. But actually, just in the last year, the government has started to do this. Last year, the Senate passed a bill called the U.S. Competition and Innovation Act, allocating $250 billion for investment in new industries and technologies, just like the ones I described, with a focus on artificial intelligence, but also with $52 billion of that allocated specifically for building semiconductor factories in the United States. And then just a few months ago, the House of Representatives passed a bill called America Competes Act, which allocates $350 billion for investment in new industries and new technologies. Again, with $52 billion specifically going for investment in semiconductor factories in the US. So 250 to 350 billion is not multi-trillion, but it's a big step in the right direction. Mm-hmm. And these two acts have passed both houses of Congress. They're now going through the reconciliation process, and presumably soon they'll come out of that process in a form that will be signed by the president, and this money will be invested. So what I'm calling for has actually begun to occur. It just needs to occur on a much more aggressive scale. And this has happened because the politicians are afraid of China. They have finally woken up to the threat that China poses to the future of the United States, to U.S. national security. A couple of years ago, then Senate Minority Leader Chuck Schumer, now Majority Leader, he made a speech in Washington before the defense community saying that he would propose a bill to invest $100 billion in new industries and technologies over the next 5 years because China was such a threat. And he specified AI in particular. And at that time, I wrote, okay, this is a step in the right direction, but $100 billion is far from enough. I'll see your 100 billion and raise you 9.9 trillion, I tweeted. But yes, so that's the reason they're doing this. And it's a good reason, but there are also other reasons that the US urgently needs to invest like this. But that is the one that is actually resulting in the investment soon to be undertaken.
Mm-hmm. So do you think that we need to, in some ways, match incentives of politicians and leaders of these industries in order to create, a real, again, incentive to make sure that these programs get invested in and stay invested in order to create this change?
Well, unfortunately, I think that the incentive is going to come from some degree of public hysteria, similar to what occurred after the Soviet Union launched Sputnik. Suddenly, it appeared that Russia was ahead of the United States in one of the most crucial technologies, and the Americans panicked, and they demanded more investment. And the politicians supplied the more investment, and we beat the Russians to the moon. And moreover, we developed advanced intercontinental ballistic missile systems that were so advanced that the Russians couldn't afford to keep up the investing on that scale, and they ultimately went bankrupt and the Soviet Union disappeared. And now Russia's economy is not as large as the economy of Texas. So that was enormously successful. And we're probably going to experience a similar pattern again, where it takes some level of public hysteria about the chances of the United States being conquered by China before politicians are incentivized enough to invest on the sort of scale that is required to ensure that we're not. It's unfortunate that it required generating fear throughout the public, both in the Sputnik era and our current era, to make this sort of thing happen. Mm-hmm. Because there are two other very pressing reasons why we need to invest on this scale. First is our economic system, which I call Credit-ism. It must have credit growth to survive, basically. If credit grows by less than 2% a year, then the economy goes into recession. If it contracts, we have a depression. So this sort of investment program would ensure that government debt grows and therefore total credit grows, and that would keep Credit-ism prospering. Credit would expand, the economy would grow. So that's the second reason we need to invest. But the third reason, really, I think, is the most compelling. I think you could call it a moral imperative. We must do this because we can so easily afford to do this, and because it would generate such extraordinary benefits in terms of curing diseases, expanding life expectancy. We could expect to rehabilitate the environment and explore the outer universe and our inner psyche. And we would have such extraordinary technological breakthroughs as a result of investment on this scale that it would radically enhance human well-being everywhere in the world. And therefore, it's a moral imperative. We can do this, so we must do it. The sooner we do it, the better. Mm-hmm. 100 plus years ago, Jules Verne wrote, 20,000 Leagues Under the Sea. He wrote about trips to the moon. That was pure science fiction. But within a century, it had all happened and much more than that. So if we can conceive of dreams for a better future now, we can accomplish those dreams. Mm-hmm. We will accomplish them, I believe, but we can accomplish them at an accelerated rate because this new economic environment we find ourselves in does allow the US government to spend on a very aggressive scale and the Fed to create money on a very aggressive scale up until recently and get away with this with very low rates of inflation. If we get back to a period where the inflation rate is once again low, then we need to immediately launch this investment program that I'm proposing.
Mm-hmm. So, we've talked about some of the healthcare, let's say, technologies that we're targeting, some of the other programs. What about energy? Do you see energy as playing an integral role in this path towards the future?
Yes, I think, we should certainly invest aggressively in renewable energy and try to wean our economy off fossil fuels. And, we should do this not only for environmental reasons, but just so there'll be greater national security. Look at what is happening now in Europe and really all around the world because of Russia's invasion of Ukraine. Oil prices have shot up. So our dependence on Russian oil puts Europe and the world really at a great disadvantage because Europe has to continue buying Russian oil, at least for the moment, oil and gas, and that's enabling Russia to finance its war. If we had renewable sources of energy, which we could have if we invest enough, then we wouldn't be dependent on oil from Russia or the Middle East. And we'd be in a much more secure position from a national security perspective. And of course, we do need to worry about the environment. We need to stop making the pollution worse and begin rehabilitating the environment as much as possible, as soon as possible.
So, just to kind of get back to a little bit about, let's say, the scope and scale of what you see, how much do you see a program like this costing? And by the end of it, do you see the possibility of actually, somewhat getting to a balanced budget, or is that kind of an archaic idea considering that we are in this age of Credit-ism, as you call it?
Well, starting out from where we are now, basically at point zero, of course, you can make projections into the future and you can have very optimistic projections or pessimistic projections. But the most important thing is just to begin this program and to persuade the American public and US policymakers that this is possible. We can do this. Therefore, we must do this and begin to do it as we are now beginning to do with these two acts that have, as I mentioned, have passed the Senate and the House over the last 12 months. So we need to start and we need to build that up. And if there is too much inflation, then we'll have to slow our plans down if we want the inflation rate to come under control. And then when inflation comes back down, we can reaccelerate the process. But for instance, these new acts that I've mentioned, both of them allocate $52 billion for building semiconductor factories and advanced chip manufacturing capacity in the United States. When they come online, then that will be disinflationary because chip prices will come down when we have more supply. So this investment, while potentially in the initial stages could be inflationary, once the investments are completed and the production comes online, then they become disinflationary. So that's another thing not to forget.
So just to play devil's advocate there, if I can for a moment, when we think about the complete supply chain of manufacturing chips, I've read that it's something like there are 20 different countries that have to contribute products in order to make one semiconductor or one computer chip. So do you see, okay, maybe we can manufacture it here, but if we don't have any of the rare earth elements or the products that actually go into making it moved onshore as well, is that not a problem that is associated with that?
I think that's a fair point, but human ingenuity is quite extraordinary. If we invest on a large enough scale, We can develop alternative products that go into the production process, different types of metals, for instance, that are more available within the United States. Or we can have these needed materials produced in countries that are more friendly than is the case at the moment. So I don't believe that is an obstacle that's too large to be overcome.
Mm-hmm. So, we've talked a lot about, let's say, the benefits that you see resulting from this kind of large scale investment. Have we covered a good amount of them, do you think?
Yes. I mean, you get the idea. I'm not a scientist, but I know enough about history and economic history and the history of innovation and the history of technology to know that when big investments are made in basic research and development, this creates industries that are something we can't imagine at the moment. It creates entirely new industries and breakthroughs that revolutionize the future. Who would have imagined smartphones 40 years ago? But it was government investment in semiconductors that led to not only semiconductors, but essentially everything that makes a smartphone smart came from US government funding of basic research and development in things like radar, GPS, touchscreen technology, semiconductors, and of course, the internet itself. Mm-hmm. So with this sort of level of investment, we would be creating extraordinary new industries that would result in products that would help humanity overcome some of its most pressing challenges and deliver many benefits society would enjoy on top of that.
Mm-hmm. So, Richard, are you aware of the book getting any traction so far with any policymakers?
Well, not in terms of any policymakers, but the book did have one very good thing that has happened for it. Martin Wolf, who is the chief economics commentator for the Financial Times newspaper, which in my opinion is the best business newspaper in the world, he included The Money Revolution in an article he wrote called The Best New Books on Economics earlier this month or within the last month. Mm-hmm. So that boosted the book's credibility, I believe, and increased the number of book purchases. So hopefully there'll be more coverage like that.
Absolutely. That's really interesting. So is there anything else that you'd like to touch on before we wrap up today's conversation?
Well, so this book came out of years and years of research that I have done. I produced something called Macrowatch, which is a video newsletter that discusses developments in the global economy and how they're likely to impact asset prices going forward. And the main themes running through Macrowatch are that in this world where money is no longer backed by gold, credit growth drives economic growth. Liquidity, meaning how much money the Fed creates or destroys, liquidity determines which way asset prices move, up or down. And the government tries to control both credit growth and liquidity to ensure that the economy keeps growing and doesn't collapse into a Great Depression. And up until now, globalization has made all of this possible by being so disinflationary that we haven't been worried about high rates of inflation. So these are the big themes that run through Macrowatch. And again, as we've touched on this already, but globalization has had two severe setbacks and is in reverse. If it remains on its back feet, then the outlook for our economy is quite dire. And the outlook for the stock market, for instance, and other asset classes is also dire. The Fed has now started hiking interest rates. They've told us they intend to push up interest rates to a significantly higher level. And worse still, from the perspective of the markets, is that they've also told us that they're going to start destroying dollars on a very large scale. This is the reverse of quantitative easing. With quantitative easing, the Fed creates money and pumps it into the financial markets. But what they're about to do now, starting next month, is the reverse of that. They're going to take money out of the financial markets and destroy it, starting at $47 billion a month in July, August, and September, and then taking that up to $95 billion a month in October, and for every month after that, which means that over the next 12 months, the Fed will destroy roughly $1 trillion or 11% of all dollars. And then it's going to continue at a rate of something like $1.1 trillion a year up until the time where the economy is essentially in recession. The Fed now needs to orchestrate a recession to throw people out of work, make them stop spending, and bring the inflation rate back down. That's what they intend to do. So that's creating a harsh environment for the financial markets. We've had a brutal sell-off in the stock markets this year. Nasdaq's down more than 25%, and some stocks within that are, doing far worse than that. So yes, if I could, I'd like to offer your listeners a subscription discount to Macrowatch. If they're interested in following my work, they can subscribe to Macrowatch by visiting my website, richardduncaneconomics.com, and hit the subscribe button. When they do, they'll be prompted to put in a discount coupon code. If they use the coupon code VALUE, they'll be able to subscribe to Macrowatch at a 50% discount. So I hope they will take a look at my website, richardduncaneconomics.com, and at the very least, they can sign up for my free blog while they're there. And if they do, then they will be able to follow my work on credit growth, liquidity, changes in government policy, the big developments in the global economy, and how that's likely to affect the value of stocks, bonds, commodities, currencies, property, and the other financial asset classes.
Excellent, Richard. And of course, again, the title of the book is The Money Revolution, and it's available on Amazon and also Audible. And of course, your Twitter as well is @PaperMoneyEcon. Richard, thanks so much for your time today. It was great to chat about the book and really get your completely different perspective on the way we should move forward in a productive way for this next decade, rather than just staring at the problems that we are currently facing.
Tom, thank you for having me on. I've really enjoyed the conversation.
Thanks, Richard. Take care.
You too. Bye-bye.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.